This is the Capitalism and Freedom in the 21st Century podcast, an official podcast of the Hoover Institution Economic Policy Working Group, where we talk about economics, markets, and public policy. I'm Jon Hartley, your host. Today, my guest is Matteo Maggiori, who is the Maggiori Family Professor of Finance at the Stanford Graduate School of Business and is a senior fellow at the Hoover Institution. Thanks for joining us, Matteo.
Thank you for having me, John. It's great to be here.
Well, it's really an honor to have you on. I think you're one of the leading international economists in the world, and really excited to talk to you. And we've known each other a long time, and I think the work that you're doing is really fascinating on all the big issues in international finance. Talking about international hegemons. It's the rise of China, exchange rates, so many topics. Capital flows that I think are so interesting to people that are global macro practitioners on Wall Street or are economists in academia. I want to first talk about your personal origins. I mean, how did you originally get interested in economics? Growing up in Italy, working at JP Morgan in London, going to do a PhD at Berkeley. Tell us about your personal origins and how you got into international finance and economics.
Oh my, that's a long story, but I guess I'll try to give you the quick version. Part of my interest, which is common, for example, with economists also from Latin America, was the big crisis of the 90s. So Italy underwent several economic crises that had to do with the exchange rate system when I was growing up. And that seemed such a huge topic. It affected everybody's life. It was clearly like on TV a lot. It was something that people will discuss at dinner. And I sort of felt, well, this is interesting. It seems like a big deal and potentially quite interesting. And my grandfather, who was not an economist, was very interested in financial issues and sort of started explaining me the basics. And that sort of stuck with me. But I didn't know that you could actually do the job of a researcher. You could make a living doing this. So I went to college. I did study economics, but I interpreted career research to be totally out of the question. I thought the professors were people that would teach and then would have a private sector job or some, one of the liberal professions. So it was not really, it was really, I was graduating and an economist called Lucio Sarno came to visit and told me.
Which schools is that?
Yeah, I was at Maurice, which is an undergraduate university in Rome. And it's a good university, but it, at least back at the time, was much more teaching focused. Today they're doing a lot more and they have a lot more research. But I didn't come from a family background where research and being a university professor was something that people could explain to me.
And did you grow up in Rome or?
I grew up in Rome. So I was born and I grew up in Rome. I then went to do an exchange in London through the Erasmus program. But I really didn't think that I was going to pursue this career. I thought, best case, I was going to be a banker at JP Morgan or something like that. And then Lucio was now a close friend. He's a professor at Cambridge University in the UK. He came to give a seminar and we met. They told him that I had finished all my exams very fast and that I didn't know what to do. And he explained to me that you could actually pursue a career like the one that I ended up doing, which was a big change for me. So I ended up doing a master with him actually in the UK. And then because UK masters are only 1 year, you really cannot get the letters for PhD by the time you want to apply in the fall because you just started. And so I ended up doing a year at JP Morgan. Well, eventually ended up being 2, but at the beginning I thought it was going to be just 1 year, trading currencies and interest rates. But by that time I was pretty sure I wanted to go and do a doctorate. But I was sort of waiting, and it was such an interesting experience actually. Ex post it was wonderful, but at the time I didn't know. And that's when I decided to apply to grad school, and then I came to the US. I came to Berkeley because it was very strong in international. Maury Obstfeld was there, Pierre Olivier Gorinchas was there, Barry Eidingren was there. It was just like an incredible. Well, actually, Rich Lyons at the time was also more involved in research, and he became a university administrator and is now the chancellor of the university. It was just a good environment to do international. But I'm one of those people that stumbled onto this career. I think the conditional probability being born in Rome and from the background I was coming from, that I was going to be a professor at Stanford, was pretty close to zero.
That's fascinating. I mean, I guess growing up in Europe, this is still, I guess, prior to the formation of the euro. I mean, was it things like the European exchange rate mechanism and the sort of early stages of the euro that was, I mean, part of your interest in?
Yeah, the ERM crisis of the 90s were a big deal for me. Those were happened when I was clearly very young. I didn't quite understand what was going on, but it was such a huge economic event. That's when I first got sort of interested in these issues. Then, of course, for a while, I wanted to be a marine biologist or something else,
Yeah.
like all kids. But eventually, when you came close to university, I would say that that experience of those crises was probably a big driver of my decision to get into economics.
That's fascinating. I mean, yeah, the whole Soros and Besson, I guess, who played a role in
Yeah.
making the Bank of England. It's fascinating, I guess, how influential that moment has been. You've had an amazing career, at Harvard and now Stanford, and really want to talk to you about a lot of your research, because I think people really, anyone who's interested in international affairs or international economics, I think, is very much interested in these issues. And I want to just start by talking a little bit about China. I mean, it's one international topic that's attracted a lot of interest in recent decades with the rise of its economy, since the Deng Xiaoping era, liberalizing its economy, growing into, being a potential hegemon, competing with the U.S. It's growing military might and so forth. You've written a really great paper on China. It's titled "Internationalizing Like China." I mean, could you explain what we really learned in the data about how far along China's come in your mind in terms of achieving or seeking to achieve hegemon status? I remember when I was working at Goldman, it was a big deal that China was increasingly entering big benchmark indices, whether they're equity or bond indices. I'm just curious, what are the facts as they're evolving, and could a multipolar world, led by the U.S. and China, work if it were to come into existence, and what might that look like if it were to happen?
Yeah, I mean, these are fantastic questions. We first got interested in China opening up the capital markets because we were seeing more and more foreign mutual funds holding domestic assets, domestic bonds in China. And right now, the situation is very peculiar, I would say. We have this gigantic bond market domestically in China. It's, depending on how you count the capitalization, it's, the second, the third largest bond market in the world, that for many years was totally shut off from international capital markets. It was actually surprisingly difficult if you were a foreign investors to hold these bonds onshore. Over time, China has gradually opened up this market. So the paper that you references with Jesse Schrager and Chris Clayton was an attempt to think about this opening up process. They clearly started originally with programs that were almost bespoke. You had to apply, you had to be a qualified investors, there was a holding period. You would think of it as almost testing the waters for China, getting familiar with what a foreign investor participating in their domestic market would look like. And then it progressively opened up more and more. So the big watershed moment was in 2017. They instituted a program called the Bond Connect that allows foreign investors through Hong Kong to enter the domestic market of China, the bond market, hold their assets and get out potentially quite quickly. And this was a much faster application process, much lighter requirements, and correspondingly, you saw a big inflow coming from foreign private investors. The investors that we normally associate as being a little flightier, like the mutual funds or a hedge fund, not the very long-term passive investors or the official creditors, like foreign central banks, foreign sovereign wealth funds. So we started thinking about this process, and we also wanted a model to think about if you're a new entrant like China, you might have many of the characteristics that are associated with a potential reserve currency down the line. You're a large country, you have a deep market, you have a lot of fiscal capacity, you're military powerful. Many of the things that we normally associate with a possible contender, China has. But currently, you have a very low reputation. You're a new borrower on the block. Nobody knows how are you going to behave? Everybody might be worried that if too much capital comes in and the next crisis, you might lock the gates, for example. You might not let them get the capital out. And so we started thinking about how you would slowly build the reputation towards competing with the US. And it's really like a trial by fire. You sort of start with, you let in very, very few investors. A crisis will eventually happen. They will get scared about you. They'll try to pull out. If you don't do anything, if you don't impair the process and suffer through the crisis, when eventually it passes, they would have learned that, you might be the good type, and they will bring in more capital. And you sort of keep going. But one of the things that this process shows you is most countries give up somewhere along the way. You have to suffer through a lot of crises to build up the reputation for being a country like the US. And most countries can't take that pain and give up somewhere along the ways and get stuck with a relatively bad reputation. And then we started thinking about other issues, which I'm happy to touch on, which are, why would China want to do this? In particular, what does it, does it impact the current account? And I really ended up thinking of it as they're trying to generate two-way flows. They're trying to have the foreigners potentially come into their domestic market, but they don't necessarily want to move the trade balance or the current account. So what do? You let some of the locals take capital abroad. So the net doesn't have to change, at least not mechanically. And you're building up gross flows. And I think it's probably for two motives. One is what we just described. You're trying to slowly build a reputation on global markets as a potentially investable asset, and eventually as a very safe one. The other one, which is probably a more immediate concern, is if you wanted to generate a financial infrastructure that is separate from the one that the US or the West controls, you need liquidity. Not all payments net immediately, not everything has a counterparty. So you need a liquid store of value. And the domestic bond market of China is really the only one with a size big enough to do it. But to do that, you need to progressively relax the capital controls. And I think that that's probably a big motive in their mind right now, particularly given all of the financial sanctions.
So have they largely just been focusing on, I guess, stocks and bonds? Like I remember, the China H share difference. I mean, they've historically, Hong Kong at some level has sort of been this intermediary to attract capital into mainland China, and they'll have H shares in Hong Kong, or they'll list some Chinese companies there. But I'm curious, like on the real estate side, my sense is that things are still pretty closed in the sense that I couldn't buy a house in China, for example, if I wanted to in mainland China. Could I own a house there?
Yes, there are, across asset classes from real estate to FDI to bonds and equities, the restrictions differ. Part of the recent liberalization was really the bond market. Very, very recently, there has been also more attempts to even liberalize the use of derivatives, particularly with the Swap Connect. In some sense, it comes hand in hand with the bond market because it's the derivatives over those instruments. We're still at the beginning of this. It's still a difficult country to invest in. There are liquidity issues, there are credit risk issues. But it's unusual to have a country with markets of that size that starts to open up. So I almost think of it as the reverse of the Bernanke saving class story. The Bernanke saving class story of the early 2000s was, look, China is opening up. It's really an amount of savings that are entering the global asset classes and are chasing, for example, US treasuries and are pushing down yields. What we might see over the next few years, it's sort of a reverse shock where China is opening up and it's creating a set of investable assets that is expanding a lot for global savings where you could potentially invest in. And it'd be interesting to see if China manages to do this successfully. Are these bonds going to crowd out emerging markets like Brazil? Are they going to crowd out the weaker, developed sovereigns like Italy? Or are they really going to show up as competing with super high-end, sort of very safe bonds in the US? Probably that's going to change through time. That's going to have large effects on yields. So far, that hasn't happened. In particular, the geopolitical tensions have meant that Western investors like US, Europe, have largely not re-entered China. after pulling out in 2022.
That's fascinating. I mean, it's interesting how I guess how much it feels like a reversion that we've seen under Xi Jinping in terms of uh, I guess not being completely on the sort of liberalization train that past Chinese leaders have been, but at some level, it's kind of I think a bit of a wanting to have the cake and eat it too kind of issue of obviously wanting to have all the economic benefits of free capital flows and international investors, but also wanting to have very strong state control at the same time. And I think it can be a bit difficult. And I think that sort of segues into this next sort of topic of geoeconomics. And you've recently sort of pioneered this topic and concept and area of study, geoeconomics. Can you explain to us a little bit about what geoeconomics is exactly and what your approach to thinking about it is?
Yeah, so I would define it simply as big countries like China or the US that are hegemons using the existing trade and finance relationships from their economies to achieve political or economic goals abroad. So let me give you some very quick example. One is I'm the US, I'm trying to get European banks not to finance trade with Iran for a geopolitical reason. And one of the things I can threaten them with is losing access to the US banking system if they don't comply. That's a very powerful threat. If you're a European bank, that's a death sentence if you get shut off from doing business with the US financial system. And so you're very likely to comply. Or if you're China, you could think of a lot of the Belt and Road Initiative is I'm providing you infrastructure, I'm providing you loans, but I'm also asking in return for you to give preferential treatment to some of my exporters. I might want to control one of your key infrastructures like a port, or I might ask you to have a particular leaning in UN votes. Those are all typical examples of this kind of economic statecraft. And it's something that economists were keenly aware of and working on in the 1950s. Then we dropped a little bit the ball on this. The political scientists have actually kept thinking about this very hard. And so geoeconomics has a long history. I think what we've been doing is trying to bring modern economics into it, just thinking hard about, clarity, like from a theoretical perspective. When do you have power? Why do you have power? How do you use optimal policy? But also, once you make it precise, you can go and measure things, and you can do policy counterfactuals. Our argument has been that a lot of macro, international, and finance theory that it was developed in the last 30 years has very good things to say about these topics. We just haven't really focused, and so we're trying to bring it to bear. And it's been great, actually. It's been exciting.
Mm-hmm. And I think at some level too, I mean, just the whole topic or tool of sanctions seems to have grown a lot. I feel like maybe 20 years ago, there's the Iran sanctions that would kind of go back and forth. But even recently, I remember maybe in 2017, 18, when I was working at Goldman Sachs, I remember that Venezuelan bonds were being sanctioned by OFAC at the time, which is the Treasury Office of Foreign Asset Control. And so that had a huge effect on Venezuelan bond prices. And now there's, we often hear about sanctioned individuals. I mean, there's all sorts of and of course, places like China and Russia have counter sanctions on American individuals or people are banned from entering those countries. And so it does feel like with the sort of rise of China and also with what's been happening with Russia, particularly since the Ukraine invasion, that there's been, I guess, a lot more discussion of these sorts of things. What should the U.S. or the allies do with the frozen Russian reserve assets and so forth? So it seems like your timing couldn't be better in this. I mean, what would be explain, I guess, maybe how does that work? Is this largely like I guess theoretical frameworks? How would you, I guess, maybe empirically think about certain sets of geoeconomics? I feel like the toolbox is so broad in the sense that you've got individuals, you've got financial assets, you've got countries that you can just sort of I guess ban flows of some form of assets into, or ban a certain country from accessing banks. What do you think about the various variety of geoeconomic tools in the work that you've been doing in this subject?
Yeah, so I mean, let me give you an answer in three parts. First, touching to your earlier argument, you're totally correct. There's been a resurgence of the use of these instruments, probably, particularly in the last few years, of which really I mean the recent past, the last 3 or 4 years. This is the biggest change we've seen to the world order, certainly in our lifetime and probably since the Cold War. So this is a pretty drastic change. Shown up in sanctions, in export controls. It's certainly shown up in the number of threats, the use of tariffs. It's really a big change. The second part is you're also correct that the canvas and the set of tools that has been used is quite varied. So a lot of what our theoretical work has been doing is trying to put this all in one framework, where you're really thinking about threats that could be threats not to buy, for example, like a tariff or a boycott. There could be threats not to sell, like an export control. There could be financial aid. There could be enforcement tools. It's actually quite possible to take all these different tools and bring them together and figure out how they enter like an economic model. That generally, I would say, enter through a participation constraint. I'm trying to get you to do something that you don't want to do, and either I'm moving your inside option, so I'm trying to make the world better for you and asking you something in return, or I'm trying to worsen your outside option. I'm telling you that I'll make your life very difficult if you don't comply. And a lot of our standard toolkit fits into this. Now, to make it concrete, it's probably easier to follow at least one example. So let's suppose that we focus on the threat not to give you access to something, like an input. Okay? And we can make it semiconductors, or we can make it financial services. So it's something that you need, that is part of your production function. It's how you sustain economic activity in your country. And I would like you to do something that you don't want to do. So my threat is going to be that if you don't comply with my ask, I'm going to cut you off from these inputs. Well, the first thing that becomes pretty clear is I can try to compute how bad is this for you. At the end of the day, whether you're not going to comply or not depends on the distance between the inside and the outside option. If I ask you for the moon over something that doesn't cost you anything to lose access to, clearly you're not going to comply. So a very simple concept of power, which we call micropower, is just trying to measure these gaps. Now, if you think about it as an economist, then it becomes clear that what matters is, well, can you get this from somewhere else? So that's elasticity of substitution versus other varieties that are produced by other countries. The typical example I give is oil. If I'm the producer of one variety of oil, I have no power. If I cut you off, other varieties are sufficiently close substitutes. Now, if I'm OPEC and I control, at least in the 70s, potentially all of the varieties, then I might have a lot of power. Because the next thing that matters is, okay, if you cannot get it, how important is this for your production function? Does he enter as a substitute for many other things, or is it close to like a Leontief input, something that without it, a lot of production will collapse? The other things that you start thinking about is, do you have a domestic alternative? Maybe you cannot get it anywhere else in the world, but you can get it in your own country. In fact, normally the first port of call when you get cut off is your own domestic economy. Do you have it? Or can you easily produce it? Well, a typical example is semiconductors in China right now. If we tell them that they cannot have access to advanced semiconductors, they're clearly going to try to produce them domestically. And the question is, how quickly and how efficiently can you produce them? So if you take this very, very basic framework, one thing that you can do is you can use sufficient statistics approach. You can say, look, with a model, I'm going to figure out that in a large class of these questions, all I need to figure out is expenditure shares and elasticity of substitutions, and then the model might tell me which of these things are essential to you or not. It's something that trade economists have done for a lifetime, but you can bring it to bear to these questions. So that's one approach, and you can see that you're going from a theory to measurement and to counterfactuals, where you're thinking about a world where I might cut you off, but we're measuring it from data that we see on the equilibrium path. Recently, so we've been experimenting a lot with that. Recently, we're taking also a different approach, which is closer to what our colleague Nick Bloom, for example, has done for years, thinking about text from the firms. The firms themselves might be talking about it. What are they doing in response? How expensive is this? And so we've been experimenting with artificial intelligence, which is really the way I think about it is there's nothing else that a technology that lets us extract so much more information out of the text compared to a simple command find, or if you're more sophisticated, like a bigram. And that has been fun. We've been sort of looking at all the firms around the world and how they're responding to these issues.
That's fascinating. And I guess just to get into these big data projects, you've been working on what's called the Global Capital Allocation Project that you run with your co-authors for a good number of years now. And my understanding of it, and correct me if I'm wrong, you're collecting all this fantastic data on capital flows. And I'm just curious, what are the some of the challenges? What are some of the challenges been with international economic data that's usually compiled from the IMF, the BIS, the World Bank, and so forth? And what's been missing in this data on things like capital flows? I know that with things like tax havens, there's some issues, and sometimes there's just some challenges with actually getting good data, but sometimes these sort of big international institutions kind of fall short. I'm curious, what's the how does the Global Capital Allocation Project fit into that? And what do we not know? Or what are the things that those big multinational institutions, what are the data sets or pieces of data that they're not tracking?
This is a great question. So we started the lab back in 2017. It was myself, Jesse Schrager, and Brent Nyman. And we had really two interests. The first one was microdata. Immediately after the financial crisis and then with the sovereign debt crisis in Europe, it became very clear that who owned which asset around the world was an important macro question, not just a micro question. Like when I went to grad school, or at least when I started, which was, the year of the financial crisis, there was this attitude of the central bank moves the interest rate, financial markets do some no arbitrage stuff. We don't really have to care about the plumbing. And then AIG happened. And we kind of realized that knowing who is exposed to what, or Lehman, made a huge difference to macro. And of course, people like Bernanke, Kiyotaki, Moore, and company, those models were there, but they weren't really as core to the to the macro finance profession as we think of them now. And they were still very aggregate. Particularly with the sovereign debt crisis in Europe, it became very obvious that you want to know who holds those bonds, where are the losses going to show up? Are the losses going to be absorbed by the investors, or they're going to get massively amplified because it's going to cause a cascade of failures? So the response to this was both in the private sector, in academia, and in the policy institutions, a massive effort to collect data. All of a sudden, we wanted to know positions. Even in finance, traditionally, we focus on prices, on returns. We didn't spend much time thinking about positions. That data was becoming available, and so at the time, we decided with Jesse and Brent that we wanted to jump in on this. And we got a little lucky. A lot of research is you try your best, but you also need to get lucky. Our luck was that one of the largest data sets of microdata around the world had become available commercially. This was like data from Morningstar. We had convinced them to give us their entire data. And that was a treasure trove because all of a sudden, you could go very, very deep on questions that traditionally, only with the aggregate statistics, you couldn't really answer. And so, for example, we worked a lot on home currency bias, which is pretty obvious once you have the microdata, but without the microdata, it was very difficult to see. That eventually led us to think about, okay, once you can manipulate the data and see what's going on, what's the right lens to look at the data? One thing that appeared very obvious to us is that a lot of positions were in tax havens. Like you look at the Cayman Islands, the British Virgin Islands, Luxembourg, so much of the world financial assets, either on the investor side or on the issuer side, are in these countries. Now, every economist understood that there's no economic activity, or there's very little economic activity going on in the Cayman Islands compared to the assets and liabilities, so the capital is going somewhere else. But when I did my dissertation, you kind of had to live with this. You sort of could decide whether to drop it, dump it, do something about it, but you couldn't unwind it. And then it became more obvious to us that you can unwind it. And that led to a lot of research, or a pipeline for us thinking about how do you get the facts straight when you have all these layers of obfuscation. And that has also led to a lot of collaboration with the policy institutions. So the BIS, the IMF, the Fed, the ECB, they have people that do fantastic work on these issues. And there's been a collective effort to produce data that is much more representative of what an economist will want to look at compared to a simpler statistical approach. So now we have a long-term collaboration with the ECB where we look at like Luxembourg and Ireland. They're like massive mutual fund centers. They show up as the biggest holders of pretty much most assets worldwide. It's very clear it's not on behalf of their residents, but where do you stick this data? Like, is it Italians? Is it Germans? Is it the rest of the world? So that has been a lot of fun. I would say that traditionally the lab, our first wave of research was all on financial positions. Now we're working a lot more with text, which I mentioned. One frontier of research that is still out there to crack is really good data on how firms trade with each other around the world. Like that data, particularly in goods and services, that data is very spotty. There are some data sets here and there, but if you think that, if tomorrow we get sanctions and we want to know what is the exposure of every US firm to foreign inputs, how does he aggregate? That data doesn't exist. We get glimpses in some data sets. And so my sense is that with everything that is going on in geoeconomics, that's going to be one big sort of next frontier that needs to be tackled.
Yeah, I mean, my sense just as a researcher is like data on firms, especially with the US. I mean, internationally we have Orbis, which is terrific. But US data can be challenging to work with. Even just like the Dun and Bradstreet data, you might have some sort of imputed number of employees or establishments, but it's pretty limited. We don't know too much about firms, and it's also hard to find their information about their exposure to various
It's pretty difficult, but my sense is that it's going to become doable, and a little bit like the financial positions that now are very routine. And 10 years ago were the frontier. It's kind of amazing how over an arc of 10 years, the profession collectively makes a lot of progress. So I'm sort of somewhat hopeful that 10 years from now, a lot of these issues will look like routine research.
Mm-hmm. You've also done a lot of work, a lot of great empirical work on beliefs and portfolios, and I think you've shed a lot of really amazing light on investors. And my understanding is, I think you run a lot of surveys, partnering, I think, with Vanguard, asking questions of Vanguard clients about their market expectations. I mean, what have you learned from that line of research when you're actually going in asking questions about retail investors? And there's a lot of, I think, discussion recently about to what degree flows and quantities matter. This is a huge question, I think, in financial economics right now. Are equity markets inelastic or elastic? If you had a $1 billion exogenous flow into equity markets, what would the effect of that be? And some like Gebex and Goyen argue that it's a $5 effect. I'd argue it's much less than that, and the market's probably more elastic in the long run than inelastic, as they might claim. But I'm curious, like so much of these sort of behavioral things in financial markets are driven by beliefs. What have you learned from that line of research?
Yeah, this was fun. This was with Stefano Giglio, Johannes Strobel, and Steve Woodcock, who at the time was at Vanguard and the head of one of the research functions. And it was really stimulated from this perspective. So I guess two things got us into this. The first was intellectually, there was all this work on expectations moving around a ton. And potentially leading people to trade a lot and therefore to explain the volatility of prices. Like one of the most classic questions of financial economics is why are prices so volatile compared to the fundamentals? The second thing that was interesting is survey technology was changing. Like it was clearly very possible to run large-scale surveys, get people to answer on their phone, on their laptop. That was becoming more and more available, and by now it's totally routine. And even when we did it, I mean, I'm certainly we didn't pioneer this, but it was sort of clear that it could be done. And sometimes you just have to, again, be a little lucky and a little bit ambitious. So we thought like, okay, the thing that is missing is to see people like me and you when we actually make our financial decisions in real life and not in a lab experiment. How do we react to our own reported beliefs? And can we get high quality data that links actions in a setup that is, in some sense, is the real world? These people are making their decisions on their actual savings to high quality survey data. And, we just got lucky. Like Vanguard was willing to do it. And they've been a wonderful partner as and institutions on this. I would love to do it with many more institutions. So far, no other financial institutions said, great, we'll let you do it. And so we ended up designing, I would say, a medium scale survey. Medium scale for me means the following. It's not one that says, hey, John, are you bullish about the market? The problem with that one is it's very easy for you to understand what I have in mind. It's very difficult for me as an economist when I get the answer to translate it into something that will constrain a model. So on the other hand, you can do very large scale surveys where you have to be a professional economist to even understand what it is that they're asking you. So we spent a lot of time designing in a way that we felt a relatively unsophisticated retail investor will understand what you're asking and has a view on this. And on the other hand, the answers are quite informative for how we design our models. And the thing that jumped out immediately were really two facts. The first one is that beliefs do move a lot. People have all sorts of views, but portfolios don't move nearly that much. So the sensitivity of portfolio allocations to beliefs, it's way low. Now that's a little bit different and not to be interpreted directly as the elasticity that you have in mind, because in some senses an elasticity to reported beliefs that are an order of magnitude more volatile than a rational expectation model would tell you would be at least for a representative agent, the expected returns. So that sensitivity was way too low. Now that one, if you take it at face value, is not great news for the behavioral approach because it tells you the beliefs could move a ton, very little trading occurs, and therefore this is unlikely to generate, at least in a very naive model, huge price fluctuations. Now there are ways to go around it, which is to think about like different sizes of investors. Maybe there's a small fringe of investors. The statements need a lot more to be complete. But that fact was pretty surprising, pretty interesting, and has surfaced in different fashions by now in lots of different studies. The other thing that showed up is how people change their mind over time. So when we started, we had the following question: is the right view of the data that you and I change our mind a lot over time, or is the right view of the data is that you're always very optimistic, I'm always very pessimistic. We both change our mind, but the first order effect is just how far are we in our beliefs to begin with. The world is really the second. Like these individual fixed effects absorb a tremendous amount of the panel of beliefs. So there's really optimist and pessimist. It's a very persistent effect. And we never found it easy to explain based on observable characteristics why in the first place is John so optimistic and Matteo so pessimistic. That's still an open question. But that has been a very fun, somewhat unusual line of research for me because it's not an international. But I thought it was fascinating. And we keep working on this. We keep sort of adding pieces of evidence over time.
I mean, that's fascinating. I mean, I'm curious, like, I do follow like some of the behavioral literature and some of the both intersections with sort of macro and finance. And like I remember there's all these papers, by I think Mian and Sufi, and there's a whole literature out there that tries to look at like consumer confidence and how much does consumer confidence actually matter for real economic variables. I'd say this is kind of maybe analogous to that. And sometimes they look at like elections, for example, and this is almost like I feel like a universal law, but basically following an election, you can see, I mean, around these periods, if, for example, an incumbency gets thrown out of office, there's a massive shift in expectations or in consumer sentiment. Basically, people feel very good when their own, preferred candidates in office, and they generally have positive economic sentiment. For people that belong to that political party, like for example, maybe after the most recent election, I'm sure you'd observe that the consumer sentiment of Trump voters would be very high probably right now versus Democrats, and so these things flip around elections like pretty mechanically, and using that for identification, I think some of these studies like the Mian and Sufi studies basically found like no real economic effect. So I think that kind of maybe speaks to some of your findings. I'd be interested if you've ever looked at how these sorts of beliefs change around elections, if maybe people sell their portfolios around.
So we looked a little bit, but part of the problem is it's not easy for us to identify who's a Republican, who's a Democrat. Okay. One of the great things with working with this type of data sets is I get to see all your wealth and all of that. But precisely because of that, there's a strong limit on not being able to identify people. So that's, I guess, part of what you get and part of what you don't get. But in general, I'm a huge fan of studies that are trying to figure out how my beliefs or my perceptions really translate into actions. One thing that, for example, was shocking to us is during COVID, and then more recently during April 2nd, the announcements of tariffs, we looked at changes in beliefs. And there were massive changes. Like, people became very pessimistic about the economy, the stock market. But when you look at their portfolios, it was shocking to me how little they sold. You would think if people become so pessimistic, you would find in the data massive attempt to liquidate equity positions. In reality, that's actually pretty small. And I was speaking to my co-author Xavier, and we haven't worked on this together, but Xavier Gabex has worked on this in another setup, and it's sort of shocking how little it is. Now, whether that translates from big or small asset price movements, that requires a whole sort of different set of assumptions and baggage that comes with it. But just as an economist, compared to at least my informed prior, these flows are pretty small. The question is, are we mismeasuring beliefs, or is the problem the way they're responding? It's just interesting. It's a mapping that I think is going to take more time for the profession to fully absorb. But it's certainly striking how large these differences are.
Yeah, it's fascinating. I think behavioral macroeconomics and behavioral macrofinance, I mean, if you call that a field, I mean, it certainly is one. Finding good answers to that, I think it's such a difficult thing to do, and it's certainly huge gains if people can make even I think marginal improvements in our understanding in that space that that's convincing. I want to just spend I guess last moments here together talking about exchange rates, and it's really a core area of international finance, and you published at length about exchange rates. I'm curious, tell us a bit about your own research on exchange rates, but I'm just curious in general, what in your mind have we learned about exchange rates in the past maybe 20 to 30 years, and maybe we've learned more, I guess, from getting better data. I feel like we've had okay exchange rate data in general. Maybe we have more high frequency data now, but we kind of had these periods where like I think a lot of international economics is born out of the Bretton Woods era. I think Mundell-Fleming, the Mundell-Fleming trilemma of the idea that you can only have two out of fixed exchange rate, independent monetary policy, and free capital flows. It was an idea that was developed out of the IMF when Fleming was working there, and I think Mundell was was maybe visiting. But obviously the world's moved away from the Bretton Woods system in the 70s, closing the gold window and the Bretton Woods system breaking up. Keynes obviously in the, I think, 50s, when he was helping to create the IMF and the World Bank, he was in favor of having one international currency being the Bancor. And I feel like we've sort of gone all over the place. And there's in terms of what we believe about exchange rates. In the 60s, Milton Friedman went head to head with Mundell about should we have fixed or floating exchange rates. And Friedman, I think, kind of won out for a while. But there's still many, many countries around the world, even today, that still have fixed exchange rates that are pegged to the dollar or in some cases to the euro. But I'm just curious, there's all these exchange rate puzzles that are out there. I'm curious, what do you think we've learned as a discipline in the past few decades about exchange rates?
Well, I mean, this is a huge question. So, I'm going to tell you a little bit of what I've worked on and what I found fascinating, also because it's a good study connects to, your very first question. So it's a good wrap up of how I got into economics. Because, I mentioned I worked for a while as a trader of currencies and interest rates and at JP Morgan. And that was before my PhD. And then what happened is I was on the job market. I had a paper that was on international, was on the role of the dollar and the US as a world banker. Xavier Gebex and Emmanuel Fari at the time had a paper on exchange rates and rare disasters. And I was on the job market, and I ended up speaking to Xavier on a flyout, and we were both pretty unsatisfied with how exchange rate modeling worked, even in our own papers. And we sort of had in mind a different model, and we couldn't really, that model, we couldn't make it work. And so we thought like, oh, why don't we work together on this? Which of course for me at the time was a great opportunity. Xavier was already like an incredibly established and talented economist. He still is. But I was just a rookie on the job market. And I thought, okay, great, let's do it. And I ended up thinking about this through the lenses of what I had seen trading exchange rates, which was a very simple idea of suppose that, today we wake up in the US and there's a bunch of people that really want to hold Brazilian real risk. They're very excited about the prospects of Brazil. They want to buy those bonds. Well, who's going to supply them? It's not going to be some long-term issue in Brazil. Probably it's going to be, before the financial crisis, some bank like JP Morgan or Goldman. Now it's probably some mutual fund that is the marginal intermediary, somebody that is willing to take the other side of that trade. And so it's giving up Brazilian real and is getting dollars. And it's using their balance sheet. I mean, these institutions are big. They have large balance sheets, but if you're trading a few billions, you're kind of moving their risk. And so they're thinking in equilibrium, do I make enough money out of this trade to justify betting the risk? And so we ended up designing a model where the limited risk-bearing capacity of these intermediaries in the middle is sort of crucial. If you're pushing dollar risk on them and you're taking away real risk, the exchange rate has to move to guarantee enough returns to these intermediaries to hold the flows. In particular, that's going to cause an immediate appreciation of the real so that over time you can depreciate, generating gains from them. And so it's a model that linked flows and financial frictions and intermediation to exchange rate determination. And it's an idea that actually had been around for a long time. Like Pentti Kuri was an economist in the 70s talking about this, but it was surprisingly difficult to make it stick in a modern micro-founded general equilibrium model. And so that's what we ended up designing with Xavier. Has been a very popular model ever since. Has been adopted a lot in academic research. The IMF, when they revised their policy framework, the financial market side of their exchange rate determination builds on that paper. So it's had a fair amount of impact over the last, I guess it's already been more than 10 years. It's almost 15. But for me, it was fun. It was a paper that sort of translated an industry experience into an academic, framework that holds together. And I didn't go to the industry thinking that was going to help me write those papers, but that paper was a pretty direct descendant of that experience. So that has been fun. You asked me what have we learned and what we've not learned. I think I would say that we've learned that this market segmentation it's pretty important that these flows do matter. They do move exchange rates around. It opens up a toolbox also for policy. We still don't have a lot of empirical success. I would say that there's plenty of evidence of financial frictions being important for exchange rate determination. I wouldn't say it's overwhelming. And I think that that's where there's excitement about positions data. Exchange rates are particularly tricky because you would think that some of the financial institutions that are most likely to be marginal in these markets are those whose data is the hardest to get, like hedge funds, very levered player. These are probably pretty important, and it's pretty difficult to get a complete picture of what they're doing. But again, there's been an incredible amount of progress on this.
Yeah, it's a great question. And in some level, I think it's just very difficult questions in terms of what what actually predicts exchange rates in the short to medium run. I think it's very hard. I think in the 2000s there were a lot of both currency and commodity hedge funds out there that now largely don't exist. There's a lot of multi-strategy funds that trade various currency strategies, and I mean, FX carry being one big strategy. And there's been tons of work in academia that's been done on covered interest rate parity and arbitrage that's sort of broken apart. I mean, it's one big area. And I think maybe one theme in your work, which I think is terrific, and in my sort of young research career here, try to do some of this, which is, I think there's so many, there's such a big chasm between academia and practice. And I think if, as researchers, we knew everything that practitioners knew, we could write better research papers. And it's challenging in part because, there's a lot of data that they can't share or don't want to share, and they also don't want to give away their trade secrets at some level. But I think there's still so much to be learned there. So it's fantastic to hear. I read Geoeconomics Maggiori. I think it's a fantastic paper, and I hadn't quite realized how informed it was by your JP Morgan experience. So I think that's terrific. I guess like one last sort of just question, I guess, or sort of big think here is any thoughts on, I guess, just the future of the world. You've written in sort of these hegemons, you've written really the canonical papers with on the sort of topic of hegemons with Emmanuel Fari and others. You wrote a great paper several years ago that talked about the decline of the euro, which was something we're continuing to see. I think the U.S. dollar has held up quite a bit, held up pretty well, I think, even through the Russian invasion of Ukraine, through COVID, through the recent early 2020s inflation. The dollar, I think, as a share of global reserve assets is pretty much still the same. And I think this is the same across invoicing, a number of things. China, I think, hasn't made, at least as a share of FX reserves, the same kind of, I think, progress that some people had hoped. There's all this talk about BRICS Bank, de-dollarization, which I think is not well founded in the data. But, so many of these things also are sort of proactive and are new, and maybe it takes time for things to change. But I'm just curious, I mean, what your thoughts are about the trajectories of China, of Europe, of the U.S. And of elsewhere. And I think back to this one speech that I once heard from Sam Druckenmiller, who's been around for a long time in investing, played a role in the breaking the Bank of England. And he said at one point, everyone thought the USSR was going to take over the world. They were wrong. Paul Samuelson wrote in a textbook, he thought that the GDP of the USSR was going to eclipse the US, and that was obviously wrong. And he updated his textbook. At one point in the 80s, people thought that Japan was going to surpass the US. That obviously was wrong. It's been wrong since the 90s. And next is sort of the China question. And I'm just curious, you study this, you study all these areas. I'm just curious if you sort of had any sort of big thoughts. Obviously, forecasting is always challenging, but I'm just curious what do you think in terms of how these big hegemons are shifting?
Yeah, so I mean, one thing is for sure, which connects to what we discuss in reputation models, is that challengers come up, but it's very, very difficult to displace the US. I mean, ultimately, the institutional strength of sustaining large markets with big foreign participations, where even in a crisis like '08, you don't essentially try to pursue policies that intentionally reduce value for foreigners. It's an incredible promise to maintain. It takes a lot of institutional strength. And most countries want to make that promise ex ante because you get good terms when you're borrowing, and when the time comes, can't fulfill it. So it's not easy to build reputation and maintain reputation at these levels. So I'm certainly skeptical of each time there is some promising young entrant thinking that it's going to be so easy to displace the incumbent. On the other end, it's very clear that we're seeing a big deterioration in the US. I mean, the fiscal situation has changed dramatically. We're not quite in trouble, but we're starting to approach that levels where these issues are going to come up. If interest rates spike, the cost of servicing the debt is going to go up. And you also don't want to go to the other extreme. If you look through history, it's not as if you once establish yourself to be a cornerstone of markets, you will always be one. In fact, you can be one for a very long time, but history shows us that you can often pursue policies that lead to your own demise. So I think the truth is somewhere in the middle. But one aspect that I think I'm focusing on these days is the difference between the implications of a rise of, for example, an alternative like China for macro versus power balances. Let me put it this way, which is, a little simplistic, but makes the point. You mentioned that China is somewhere around like 2 or 3% of the international use of currency, depending on which exact measure you use. Now,
let's the US, which is like 50,
in this high 60s,
60, 70%.
Yeah. Now, let's quickly agree to a scenario where 10 years from now, the US is still in the high 50s. China's gone from 3 to, let's say, 7% to 10%. Okay. I have no idea whether this is likely or not likely, but we're not talking about neck to neck. We're not talking we're 50-50. Now, what's the consequence of that? Now, I would say for macro, relatively little. I don't think it's going to change the transmission of monetary policy, the way exchange rate works, tons of the usual stuff, very, very little. But now go back to the question of sanctions or exerting power to the financial system. For that question, this is an absolute disaster. Why? Because imagine sanctioning a country the size of Brazil or Russia. If China is 10% of the usage, that's plenty of liquidity for them to conduct business with. So power is really about concentration of the shares, and coming down from having 95% of the shares to 85 is a big loss in your power compared from 85 to 75 and so on. So I think I always invite people to be careful about how we interpret those shares, because what they mean really depends on the question. So if China, for example, develops a successful payment and settlement system that is pretty liquid and can easily accommodate a small open economy using it, that's a big loss to Western power. Does it make a huge difference to many other questions in macro? Probably not. So those are also much more realistic than a world where in the next 5 years, China is 50% of the world financial system, which, who knows, but seems rather unlikely. And I think it leads to a bit of a policy mistake, because if you're thinking that none of those issues are going to arise until we're really neck to neck financially, then you can be very complacent about the development of China financially, because it's going to look small for a very long period of time. But those small shares can make a very large difference, particularly in geoeconomics, even if not in macro.
Mm-hmm. I think it's just so hard, I think, at some level to dislodge a hegemon. You think about, the last time the world hegemon, global reserve currency changed, it took a couple world wars to basically dislodge the UK from having the pound as the world reserve currency, and in a world where we have nuclear weapons and across many countries, war becomes increasingly less likely to happen.
We might end up living in a world where fragmentation really means on the hedges, and where the US is still very, very dominant, but all of a sudden there are two or three other players that can provide meaningful, for example, financial services. Now that world for power makes a big difference, even if it doesn't look at all like a complete reversal of the current equilibrium.
Mm-hmm. Fascinating. Yeah, absolutely. Well, it's a real honor to have you on, Matteo, and talking about your amazing career and contributions to international finance.
Fantastic. Well, it was great to do it. I'm glad that we got to do it.
This is the Capitalism and Freedom, the 21st Century Podcast, an official podcast of the Hoover Institution Economic Policy Working Group, where we talk about economics, markets, and public policy. I'm Jon Hartley, your host. Thanks so much for joining us.